emerging markets diverge, don't they? I mean, the biggest example, BRICS, aren't they, which are all going through different things at the moment. Are they still together enough to look at as an entity?
No, Michael, I think it's impossible to look at it like one homogenous entity. There's definitely increasing polarization between large emerging markets, and that's a trend that's set to continue. If you look at the world today, you have slowing Chinese growth, a collapse in oil, a relatively weak external demand environment, strong U.S. dollar, and rising U.S. Fed rate hikes. And so it's the countries that have strong, sustainable domestic drivers of growth that will prosper in this environment.
Thomas, do you regard them as a lump?
Well, I think there's a lot of overlap as well. I mean, where do you consider Greece as an example, which is now classified as an emerging market? So I'm not sure that having an election is necessarily a positive dynamic. So again, frontier, emerging, or developed in all cases, actually. So I mean, I would define them as three distinct different asset classes, and actually within emerging markets, as your leading question said, there's a lot of differentials as well. And I think also as an asset allocator, we have to break down the difference between emerging nations as economies and emerging nations as investment opportunities. And I think that polarisation and that bifurcation has never been greater than it is at this point in time.
How do you access them, Alistair?
So, in terms of investing in stocks, then there's a huge liquid, dynamic, varied investment universe for us. We calculate there are over 3,000 stocks across emerging markets and frontier markets, which trade over $1 million a day. So we think this is very fertile hunting ground. For some markets, we require instruments like P-notes or GDRs, but on the whole, liquidity isn't an issue. It's finding the right company exposed to the right sort of change that we look for.
Minesh, how do you look at these widely differing markets, which are obviously great for yield?
BRIC was termed by Goldman Sachs, and that became an acronym for the whole industry of emerging markets. And I don't think it's fair to compare India to Brazil and Russia. I think the dynamic's entirely different, and I think the clear divergence of global emerging markets now is the political stability in some countries. I think the skill of standard life, etc., is to find that divergence and find where the opportunities are.
Most families want to have some kind of international orientation and some kind of international exposure within their portfolios, and want to be global citizens. And I think excluding emerging markets from your portfolio is a mistake, because ultimately that's where the future growth is going to come from, and you want a portfolio that will capture some of that.
In the light of what the panel have been saying, can you just give us an overall macro view of where you think emerging markets are right now?
The boom years of the 2000s have resulted, I think, in emerging markets that are much less vulnerable than they were in the 90s from a financial and macro stability point of view. They're much more resilient. However, you're not going to see the rapid growth that you saw in the 2000s. As I mentioned before, the drivers of growth are much different. Now it's going to be largely structural reform driven. There's less of a tailwind from fast Chinese growth and from the commodities demand coming out of China, and much slower growth in the developed world. So it's going to be a weaker external environment. So I think the growth alpha between emerging markets and developed markets is closed a bit. You'll definitely still see faster growth in the emerging world. However, it's going to be more moderate and hopefully more sustainable than it was in the boom years of the 2000s.
I'd just like to ask the panel, where are the less obvious opportunities within emerging markets?
Right, less obvious ones. Who'd like to start with that?
I still think that frontier markets are overlooked, partly for good reasons in terms of liquidity is not as high as in some of the bigger emerging markets, but partly for bad reasons in that they're a bit off the beaten track. You have to work a bit harder to go and meet companies. But in terms of the quality of the company, the strength of longer-term growth opportunity, the quality of management, and even more importantly, the lack of correlation with other emerging market risks. I think there's a huge opportunity out there. Some of the Middle Eastern countries in particular are interesting us at the moment.
The market often makes blanket assumptions. So your countries that are oil exporters, for example, when you get a move in the oil price like we've just had, you get a situation where I think, particularly exacerbated emerging markets where everything sells off, and that gives you, I think, often, you've got to try to make the volatility work to your advantage effectively. And big moves like that can give you the opportunity to pick up some quite interesting opportunities.